Good morning and welcome to today's webinar, Higher Yields and Attractive Value in EM Local Currency Bonds. I'm Bill Sokol, Senior Product Manager at VanEck, and I'm joined by Fran Rodoloso, Head of Fixed Income ETF Portfolio Management and Portfolio Manager of the VanEck J.P. Morgan EM Local Currency Bond ETF. Fran, thanks for being here.
Good morning, everyone, and thank you, Bill.
Um, uh, if you have a question at any time throughout the presentation, please type it into the Q&A box on your screen, and we're going to get to as many of them as possible at the end. But today, we are going to take a look at diversifying a U.S.-centric portfolio with EM local currency bonds. EM local currency bonds provide high yields, which have driven outperformance versus U.S. and global fixed income markets over the last year and have gotten a lot of attention recently. We're going to look at EM fundamentals and talk about why we think currency strength can continue from here. And we're going to discuss why some of the biggest themes in the market right now, topics like de-dollarization, the policy and political uncertainty that you see pretty much everywhere you look right now, and even the energy build out, why we think these can benefit EM local bonds going forward. But first, let's take a look at yield. The high yield of EM local currency bonds is certainly one of the more attractive characteristics of the asset class for income investors. Right now, you're getting about a 6.5% yield on EM local bonds. And I would note when you look at this slide that the other asset classes that do provide higher yields tend to be non-investment grade. Or in the case of EM dollar sovereign bonds, primarily non-investment grade. EM local currency bonds are primarily investment grade. So you're getting a high level of yield without a high level of credit risk. And we think that can be very attractive. Right now, the asset class is giving you about, or actually over 200 basis points of additional yield over the US broad market, so above the US ag, and over 250 basis points above broad global developed market sovereign bonds. So a very substantial level of yield right now. Now we're going to talk about this more throughout the presentation, but one reason why EM local bonds can help provide diversification within a portfolio is that you actually have two distinct sources of return. So you have the high local yield, so it's not directly tied to US yields, it's actually in the local currency, but you also have that potential for currency appreciation as well. And on the left chart on this slide, we show how EM currency returns have looked over the last decade. The dark blue line is the currency return of the index, and you can see a meaningful increase over the past year, and that's certainly been one of the big stories lately. But when you look longer term, certainly it's clear that EMFX has not always been a tailwind to return. It's actually been more of a headwind in several years. And this means that EMFX levels are coming out of a very sustained multi-year decline. And it's interesting when you look at EMFX returns versus the gray line, which is the dollar versus developed market currencies. You can see that that line is essentially flat over the last decade, whereas EMFX has underperformed. So EM currencies are not starting from a point of being overvalued. Now, we also look at returns on this slide, on the right-hand slide, and over the past decade, you can see that EM bonds have significantly outperformed global bonds and the US ag. This is because of the higher yields you get, and at least at times, the currency appreciation that provides additional total return. We also show what a blend of local currency and hard currency would look like, and that's the green line. Just to illustrate a more diversified, broader exposure to EM bonds. As mentioned earlier, the hard currency EM universe is providing a higher yield that does come with more credit risk, but that higher yield has driven performance higher. And those bonds do benefit from many of the same dynamics that we're going to be discussing today. Now, despite this outperformance, we do find that many investors are underallocated to the asset class. In the last year, I would say we've begun to see investors take a look at EM bonds or return to the asset class, at least in some part. And that's probably not surprising when you look at the returns that we saw last year, with EM local really being by far the highest performing fixed income asset class last year. We think this interest and the performance is reflective of the structural tailwinds for the asset class that we're going to be discussing today. And we actually believe that the current backdrop does bode well for EM bonds going forward as well. So we don't believe it's too late to add exposure if you are underallocated. In fact, the strong returns that we've seen in 2025 have continued into this year. And on this slide, we show year-to-date returns with local bonds continuing to outperform very strongly. So, Fran, let me hand it over to you to do a deeper dive into what drives these returns.
Great, thanks, Bill. So as you just mentioned, Bill, EM local debt in particular has gotten a lot of recent attention due to significant outperformance versus almost all other fixed income, not just the ag in 2025, where it performed roughly 18% total return. If we go to the next slide, we can see sort of year by year returns. Bill also just pointed out in one of the earlier slides that really emerging market local debt and emerging market debt overall has been outperforming the U.S. ag and the global ag for most of the last decade. What this discussion today is about is that a lot of the key drivers of that outperformance are still in place. And a really important point, I think, is made by the slide we have up now, which is that one of those key drivers last year, or a driver, were currency gains. But that is not historically the key driver of outperformance of EM local currency debt. The chart we're looking at shows the FX returns in a light blue and the local rate or duration returns in gray for each calendar year. And then you see the total returns, or the bar to the far left of those, which is the total return for the asset class. Most up years over the last 18 years on this chart, most years of outperformance or decent performance in the asset class has actually been driven by that high yield that Bill was mentioning, which leads to high carry, and also local rate returns. And the majority of return last year came from carry and duration as opposed to FX. And looking forward, we think a lot of the pieces are still in place for that to continue. We have a sustainably high yield. We believe FX will at least be steady versus a dollar, and there are a lot of reasons to see further appreciation, but that does not need to be the driver. Maybe if we go to the next page, another comment on FX. Bill showed a chart earlier where nominally over the last decade, emerging market local currencies on average underperformed the dollar by roughly 15%. This chart is going back 18 years or so, looking at EM currencies a different way on a REER basis, or real effective exchange rate, which is not just against the dollar. It's sort of a trade weighted measure that takes into account a variety of factors. You can see there's been recovery over the last several years from complete underperformance of the basket of currencies that are in the J.P. Morgan local EM indexes. But these currencies that have performed better on a REER basis in these years are some of the stronger EMs. These tend to be larger economies, tends to be the ones with more developed and deeper capital markets. That's the type of countries that make it into this emerging market local currency index. Generally speaking, long story short, we believe there's still upside from here on a nominal or real effective exchange rate basis, even if we don't believe that needs to be the key driver of returns for the asset class. So that durable yield advantage that Bill has mentioned is really super important. Another very important dynamic for debt and forward returns, of course, are fundamentals. And EM has an advantage there as well. And this is really why we think the return profile can stay very positive for emerging market versus developed markets. Let's start with growth, a super important fundamental when it comes to paying down indebtedness in the future. And emerging markets, almost by definition, have a growth advantage over developed markets. It's important to note that that advantage has widened out again in the post-COVID era the last couple of years, and is expected to be sustained over the next 4 or 5 years. So that at the same time is happening as EMs are reducing, in some cases, their debt, and certainly not posting as difficult a fiscal situation as some of their developed market counterparts. But let's go first, before I talk a little bit more about that. Next slide, just look at the starting point, debt to GDP. So leverage. EMs are less leveraged, of course, than their developed market counterparts. I say of course because by now many people have probably heard that story. Of course, that's counterintuitive to what the decades-long story has been about emerging markets and bad debt cycles. But emerging market on average debt to GDP stand in the low to mid 60s today, whereas developed markets on average are about 110% of GDP. US is actually higher than that. US is expected to get out to about 140% of GDP over the next 4 years. So higher growth, lower debt. Those are two great fundamentals. Balance sheet is of course super important yardstick when deciding where yields and ability to pay stand. Go to another sort of fundamental. What about external vulnerabilities? We talk about potential for currency volatility in EM, boom and bust, etc. When there were a series of defaults in emerging markets in the 80s, the 90s, there was huge dependency on debt denominated in dollars. There were asset liability mismatches, etc. I think a really important note over the last couple of decades is how much, especially those countries that are in the JP Morgan local currency indexes, have reduced their external debt financing, or the amount of debt they have in dollars and euros in particular, and they've raised more in local capital markets. This makes them much less vulnerable to currency swings, to any sort of convertibility issues, etc. So lower vulnerability is another important fundamental that we think is underpinning the now long-running outperformance of EM debt versus developed market. Let's maybe take another look at yield from another point of view. And if sort of higher yields and better fundamentals are the first two important things to note, probably just policy and policy flexibility is a third really key aspect of emerging markets, better set up than developed markets as we look out the next 1, 2, 3 years. So this chart on the left is showing nominal yields in the countries included in JP Morgan's EM local index, and you see some of the key developed markets on the right. Of course, we've mentioned numerous times already the higher nominal yields, but we've also got higher real yields in emerging markets, and that's reflective, of course, of what emerging market central banks have done in terms of hiking rates several years ago, really sooner and more aggressively than their developed market counterparts. The jobs they have done on average in combating inflation. It also, looking forward, points to the policy flexibility that many emerging market countries still have, and why many are still poised to ease in 2026, even if less so on average than in 2025. But developed markets are even later stage of that global easing cycle, so potential for lower rates. And by the way, in many of these emerging markets, you also have steeper yield curves than you have in the U.S. So potential impact can be even greater from that perspective. A couple of other things to mention here. These higher real yields are super important from a policy perspective, and that, as I said, might be the third sort of key driver of forward-looking returns. Also, if you note, we've talked a lot, all of us, the press, in markets in the last couple of years about the sort of cycle, the economic cycle, the changes going on, development of AI, resource scarcity. So many of the EMs on this list are, net oil exporters in the case of, say, even Brazil, by the way, is a net energy exporter. Colombia, Mexico is very close net on all products, but a crude exporter. Metals, South Africa, Chile, Peru, other commodities, Indonesia, Malaysia. You've got a lot of countries that can benefit from that part of the changes in the global economic cycle as well, which is another strong fundamental underpinning. That I'll maybe pass it back to you, Bill.
Yeah, so I wanted to spend a few minutes talking about using EM local bonds in a portfolio. We've certainly seen renewed appreciation, I would say, for international diversification over the past year among investors. And I think it's pretty clear when you look at a correlation table like what we have up on this slide, that EM local currency bonds are a less correlated asset class. You do get a strong negative correlation versus the US dollar, and I think that is an important and now an attractive feature of investing in local currency bonds right now. You also get lower correlation to asset classes like IG corporates, US high yield, and even US equity and EM equity versus other parts of the fixed income market and other parts of the EM bond market as well. So EM local currency bonds are not moving in lockstep with the rest of your portfolio, and can be a way to add diversification into your broader fixed income allocation. So you can diversify away from U.S. Rate policy and what the Fed's doing, or diversify away from volatility or weakness in longer term U.S. bond yields. And we see a case, for that to continue for sure. And of course, you get these benefits while also getting that higher level of income. So we think it can be a great addition to a broader global bond portfolio from both a yield and diversification perspective. Now, when we talk to investors who do have a EM debt allocation, we do find that many often have that through a hard currency strategy. So whether that's a passive beta approach or an actively managed fund, typically that tends to be all or primarily hard currency. And I think this is generally just, due to some aversion to adding currency risk into a portfolio. As we discussed, the currency exposure is what gives you that diversification benefit. And we do see many fundamental reasons why EMFX appreciation could continue to be the story going forward. So with a hard currency allocation, you're of course not going to get either of those benefits. And importantly, as Fran touched on earlier, the makeup of the hard currency market is very different from the local market in terms of what is included. In local currency, you do tend to get the larger issuers, those with a more robust internal market, established legal, regulatory infrastructure, and those are the countries that are able to raise capital globally in their local currency. If smaller countries or those that just are totally inaccessible to foreign investors, they're much more limited in where they can raise capital in the global capital market. So the hard currency market is one area they can do that. But the result is that the hard currency universe is dominated by non-investment grade and smaller countries. And you see the differences in credit quality on this slide, characteristics, and countries. The hard currency market is a credit market. As Fran mentioned, hard currency debt, it does introduce vulnerability to external shock. So there is a linkage between currencies and credit risk that investors should not lose sight of when they're investing in hard currency bonds. But overall, you do have a very different risk return profile between local bonds and hard currency EM bonds. You have different credit profiles and, of course, a different set of issuers. So We do think there's a case for both. It's not one or the other. Both can provide benefits in a portfolio and again have different risk and return drivers. We also find that some investors have EM equities and they view that as their EM exposure within a portfolio. There's obviously differences in terms of asset class between EM debt and EM equity, but there's also some very stark differences in terms of your regional exposure and by extension your currency exposure from an equity allocation versus debt. The broad EM equity benchmark is heavily dominated by Asian companies. So Chinese, Taiwanese, South Korean companies together, as we show here, have an 80% weight in the index, or all Asian countries together. And I think it's important to note that that currency exposure is tends to be more highly correlated to the dollar. Many of those currencies are managed to the US dollar. So from a currency perspective, you're not getting the same exposure or the same diversification benefits that you're getting with a debt allocation. Of course, you're not getting the income either. So we don't view EM equity as a replacement for EM debt. These are two very different asset classes. Friend, we've talked a lot about the benchmark, where we use the benchmark as a sort of a proxy for the asset class. So maybe we should do a deeper dive into what is included in the benchmark. What are investors actually getting when they invest in something like EMLC?
So yeah, let's move a page forward and look a little bit at the index methodology. So as we've mentioned a few times, the index underlying EMLC is a JP Morgan GBI EM Core, which is very similar to the GBI EM Global Diversified, which is widely accepted as the benchmark for emerging market local currency debt. We've listed a bunch of index construction rules here, but maybe I could summarize it by highlighting a few of the bullet points. Number one, whereas JP Morgan has its own definitions for what are emerging markets, and by the way, that would leave out, for the purposes of this index, Korea and Taiwan, which are one of the reasons why we have a lower Asia exposure than EM equity indexes. Another is because there are country caps, but get to that in a second. But look at the last bullet under country criteria. We exclude countries where local market investing is subject to capital control. So the GBI global indexes, EM global indexes, will not include some of the frontier markets or markets where there's a lot more potential friction. So this tends to be the larger economies, as we mentioned earlier, ones with deeper capital markets and lack of capital controls. So that's one important aspect that leads to higher quality issuers overall. In terms of liquidity, look at the second bullet. Just there's constant measuring going on and making sure there's two-way liquidity in these bonds or minimum issue sizes. And then the weighting methodology, the 10% country cap. Otherwise, China, for instance, would be a much larger than 10% weight in this index. So although it is market cap weighted, there's both a cap and a floor that enforces a certain level of diversification that tends to enhance return and risk over long periods of time. So JP Morgan has been a leading indexer in the emerging market space for more than 3 decades now. So we think it's important that we're tracking a JP Morgan index. What does that mean in terms of the portfolio then for EMLC? Well, let's look at a few of the characteristics on the next slide. Credit ratings, let's start at the far right, almost 85% investment grade. So that's, we talked about the quality of these countries and the fact that they have very strong fundamentals relative to developed markets, although it does not put many of these countries into double or triple A status. Certainly, a lot of A and triple B rated issuers, and so those fundamentals are reflected by investment grade ratings. We mentioned the yield, 6.7% yield to maturity, with a average effective duration of about 5.2. So fairly moderate duration relative to global, say, ag benchmarks for that yield advantage. So again, well-constructed index. Most of the countries do have well-developed curves, and I've mentioned earlier that some of those curves have a certain degree of steepness that we think makes them more attractive as well than their developed market counterparts right now. Let's go one more slide, a little bit more on some of the characteristics. Bill showed compared EMLC to uh, equity indexes in terms of regional exposures. This breaks it out a little more, the pie chart on the left, but as you can see, Asia is still larger than Latin America or Eastern Europe on an individual basis, but much more constrained than it is in other capital markets. So you've got a fairly evenly distributed uh, geographically speaking index. And you can see the currency exposures on the right again, China and India at the top, up against those 10% caps. By the way, the indexer has noted to the public that they might be considering lowering that cap by a percentage point later this year. That's still under review and to be determined, but that would only further enhance the diversification in this product.
Thanks. And as we get towards the end of the prepared part of our presentation, I just want to highlight EMLC. Investors can get exposure to a diversified portfolio of EM local currency sovereign bonds with EMLC. It tracks the GBI EM Global Core Index from JP Morgan, which Fran mentioned is the part of the suite of the most widely followed benchmark among EM debt investors globally. EMLC investors benefit from a high yield, right now a 30-day SEC yield of 5.8%, and the potential to benefit from the long-term tailwinds to EMFX that we discussed today. In addition to EMLC, VanEck does offer a suite of international and EM bond ETFs for investors looking to diversify their US fixed income exposure. EMBX is the actively managed emerging market bond ETF. It invests across the entire EM debt universe, sovereigns and corporates in both hard and local currencies through a bottom-up process. And EMBX may be attractive for investors who don't want to make their EM debt allocation based on a decision around the dollar or US rates and simply want to invest in the most attractive parts of the market right now. EMBX currently has a 30-day SEC yield of 5.6% and a strong track record of outperformance since 2012. For investors looking for even higher yields, HYEM has a 6.5% SEC yield. It invests in EM high yield corporates, which we believe are an attractive complement to US high yield, with a higher tilt towards higher rated companies. IHY can help high yield investors build a complete global high yield portfolio with exposure to non-US high yield companies, including emerging market issuers. And lastly, CBON is the only US listed ETF providing broad exposure to the onshore China bond market, which is second in size only to the US. With that, we've come to the end of the presentation. If you have questions, please ask, and we're going to get to as many of those as we can. Fran, just to kind of kick things off, we've touched on this throughout the presentation today, but has this trade played out? We saw the strong returns over the last year or so, but is it too late? Like, what can investors expect going forward?
Yeah, I think we tried to make the case that there is a yield advantage that is being sustained in this space. Number one, number two, that the currencies actually are potentially poised to at least remain stable over a longer period of time versus a dollar. And in many cases, there's possibility for further appreciation. And all this is based on the fundamental pictures. And of course, there's momentum against the dollar right now, which might have more near-term benefits for an allocation of the space. But the case remains the same for EM debt, which is from a looking out to 5, 10 years, the path of fundamentals is simply a lot stronger from a debt dynamic perspective. So we think this is an opportunity to add quality even if the ratings don't necessarily fully reflect that. This is still mostly an investment grade universe. You're getting higher yield, you're getting higher real yields. An important aspect as well is simply that more of the EMs are poised to have a little more easing left. They have more policy flexibility coming into 2026 than their DM counterparts. And so we think that's an added advantage of an allocation today as well.
Next question is around just global monetary policy. We're obviously been in this easing cycle. Is the current easing cycle coming to an end, and what are the implications of that?
Yeah, I think for a large part of the universe, the world, both EM and DM, it may come to an end in 2026. I think on average, even if the US may resume easing mid-year, for the developed world, we are very, very close to the end. And on average, I think you'll see policy rates not move downward this year. On the emerging market side, there are still a number of countries. I mean, Brazil has not begun its latest easing cycle yet, and policy rates are at 15% currently. Indonesia, Romania, South Africa, Turkey, all likely some easing this year as well, on top of many other EMs that may have one or two moves left. So that is a potential driver for sure. But look, if the EMs do what they've done over the last decade, which developed markets have not, which is pursue a more orthodox and let's call it cautionary monetary policy with regard to inflation, then that would also have the added benefit of keeping yields high and being supportive of currencies. But again, that being said, we think on average, you'll see policy rates probably move lower in emerging markets this year versus developed markets, even though we are late in the cycle.
And we have one more question. Where should investors fund an allocation from their portfolio? We obviously talked about the benefits of an allocation within a portfolio, but for investors who would be looking to allocate, how could that be done? I mean, I guess I have a few thoughts on that, and Fran, I'm curious to get yours, but I think to the extent if you only have a hard currency allocation, I think perhaps putting some of that into local currency would make sense to kind of get the full benefits of a broader allocation. And we did kind of look at what that would look like. But I think maybe when you look sort of where probably most of your fixed income allocation is, and something like the ag, or to the extent you do have exposure to other developed market global bonds. I think there's just a very strong case to take some of that and put it into low EM bonds, whether that's all local, whether that is local or hard. Um, EM local bonds, EM bonds, they are not part of the ag, right? So you're not getting that exposure. You may be getting very little in a global bond fund as well. So I think all of those could be very good candidates to take an allocation from. Fran, what do you think?
Yeah, I think you hit it on the head. The first natural thought would be maybe from your hard currency EM exposure, but to your point, I think since most investors have proven to be underallocated to emerging markets in general, and if the goal is really to get further away from pure treasury or developed market exposure, or at least diversify it a little bit, that funding it from those ag or ag-related asset classes makes the most sense to me as well.
Well, we don't have any more questions. So I want to thank everyone for joining today. Fran, thank you. And that concludes today's webinar. Thank you very much.
Thanks, everyone.